discussion about the different market structures. On this extreme, we have perfect competition, and on the other extreme, we have monopoly. Now, of course, there are various factors that differentiate these two, but the main factor is lots of sellers or firms, right, in perfect competition, and in a monopoly, you only have one. Only one. In an oligopoly, you have a few, right? And a special case of an oligopoly where there's only two is a duopoly. And then, of course, you have your monopolistic competition, right? You have many sellers over here or many firms over here, but the products are a little bit different. So in perfect competition, it's exactly the same products, but in monopolistic competition, you have different products. And we've got a very nice chart coming up which is going to detail all of this, but I just wanted to give you a high level mental map before we get into these details. So what is a market? A market is defined as a group of buyers and sellers aware of each other, and they're agreeing on a certain price for exchange of certain goods and services. We're going to look at 4 different type of market structures: perfect competition, monopolistic competition, oligopoly, and monopoly. The two extremes, perfect competition and monopoly, where you've got the number of firms being huge in perfect competition and only one in a monopoly, and profits, of course, also maximized in a monopoly. And the other two, which is monopolistic competition, oligopoly, they are falling somewhere in between. So what are the factors that determine the market structure? Of course, the number and size of firms, right? The higher the number of firms, the more the competition is, and perfect competition, of course, means the highest number of firms. Same products. If the products are different and you still have high number of firms, then what you have is monopolistic competition, that at least there is some difference in the products these firms are bringing. And think of smartphones, think of automobiles, right? That, okay, there are so many different companies, but at least their products are a little bit different. So that is going to be monopolistic competition. The more you go from perfect competition towards monopolistic competition, and then towards oligopoly, and then monopoly, the amount of pricing power goes up of the sellers. A monopoly has perfect pricing power. A perfect competition firm has zero pricing power, right? They are price takers. Monopoly is a price setter, or it can influence the market price. And what makes a monopoly a monopoly? It is the barriers to entry, that nobody else can enter that market. Nobody can become a seller in that market. And of course, with perfect competition, there is no barrier to entry. Anybody can come in and start selling onions or milk or whatever are these homogeneous products. The degree of non-price competition, there is none in perfect competition. It is all based on price. As you move towards differentiated products like smartphones, automobiles, there is non-price competition on features. And this is the chart that I told you about. Very, very important from an exam perspective, because many questions can come from this one chart. Now let's discuss this. In a perfect competition, you have many firms. The barriers to entry are very low. Anybody can come in and become a supplier in this business. Same products. Think of oranges, milk, wheat, exactly the same products. No non-price competition, and there is no pricing power for the firms. They are all a price taker. They face a flat horizontal demand curve, which is the same as the price and same as the marginal revenue. Now, as you move towards monopolistic competition, you still have a lot of firms. It's just that the barriers to entry are not that low anymore. And even though easily substitutes are available, but there is some differentiation in the product. Think of toothpaste, smartphones, automobiles, that of course one is a substitute for the other, but at least there is some differentiation, some advertising, right? So therefore some pricing power. Samsung might price their phone above a Redmi or a Xiaomi. Not that either I'm supporting either one, but the point is just to give you an example that some brands might have a premium pricing for some premium features and vice versa. Right? Oligopoly, fewer firms. Barriers to entry are high. Think of oil production companies, Exxon, BP, Shell, Aramco, ADNOC, few companies, high barriers to entry. And it's not because they are having complete differentiation of products. Oil is homogeneous, right? Or close substitutes. But it is the few firms, the low number of firms which makes a certain market structure oligopoly. It's not that the product is differentiated or the product is having homogeneous nature. It's just the fewer firms because of the high barriers to entry that makes an industry, a market structure oligopoly. You can have advertising, you can have product differentiation in oligopoly as well. Of course, the pricing power is going up because fewer players are there. Think of cement cartels, think of sugar manufacturing, high barriers to entry, and therefore they have pricing power. The example here is commercial airlines for a given route, right? And think of, let's say, between LA to New York. Not everybody is flying between LA to New York, so there will be a certain number of few firms that are flying and they will have a certain amount of influence on the price for that route. Now, monopoly is, of course, just a single firm. Their barriers to entry is very, very high. Think of power distribution companies in your local community. They have a unique product. Nobody else can provide that. They do, however, spend on advertising and they have almost perfect pricing power. Examples include electricity provider or water, gas, utility companies in your local community. And since these are natural monopolies, well, not natural monopolies, but they are monopolies, they are controlled by the government. A natural monopoly, by the way, is referred to something which inherently by the nature of its business is a monopoly. All right, so now that we have discussed this, which one has the most pricing power? Of course, monopoly and oligopoly. And from the previous discussion on this learning module, you must have by now picked up that how important pricing power is to maximizing your profit, because obviously you can only maximize your profit if you are able to price your good at the point where your MC is equal to MR. If you can charge this price, then you can maximize your profit. But then obviously a perfect competition cannot do that. They cannot control the price, and what happens is that prices drop as more suppliers come in, and therefore it is perfect for consumers. But we as financial analysts are of course looking to provide capital as investors or as providers of debt, and therefore we will be more interested in investing in firms which are in market structures which are more towards monopoly and oligopoly, so that they have higher pricing power and they can maximize their profit. So now moving from perfect competition to monopolistic competition, still high number of sellers, but products are differentiated. Think of fast food chains, think of smartphones, automobiles, right? So they are able to differentiate their products. And then of course within these industries, you'll find players which have been able to really carve out a niche for themselves, right? So you can think of them as like small monopolies. And I like to think of Apple as one as well, because within the smartphone industry, of course, you've got the Samsungs and the Huawei's and the Redmi's and the Xiaomi's, but then they don't really compare to Apple, because obviously Apple has a completely separate product offering. So you can think of that like a small monopoly within that monopolistic competition space. And the same goes for Harley Davidson motorcycles, right? I mean, you've got all these different motorcycles, and then you've got these Harleys which are completely different. Anyhow, so what are the characteristics of monopolistic competition? Large number of buyers and sellers. Products are close substitutes, but they are still having some differentiation. There is very low barriers to entry, but it's not as low as perfect competition, but nevertheless, there is low barriers to entry, some pricing power, right? Samsung, Apple, Huawei, of course, they have some pricing power. It's not like perfect competition where there is absolutely no pricing power, and if you're selling milk, you have to sell it at the price where everybody else is selling. How do firms differentiate their products? Of course, they use advertising, and think of automobile ads. And there's some very, very interesting advertisement campaigns that BMW does versus Audi. So that's a good example of monopolistic competition advertising. And there could be non-price strategies as well in terms of features. The profitability doesn't change in terms of maximizing your profit, where MC is equal to MR. So you can see this is your MR, this is your MC, and where is MC crossing MR? This is the point. This is the point where you will produce, right? And this is going to be your price, where it's going to meet the demand curve. So this will be your price. So this whole box where you are going to take this price and multiply it with this quantity, this is going to be your revenue, right? And the cost, which is obviously coming from this average total cost point, this cost is going to be multiplied by the quantity. So this box on top is your profit. So let's understand this chart in more detail, that since the products are unique, you're not really dealing with a flat price like you would in a perfect competition, where the price is the same as the marginal revenue, same as your demand curve. That is not the case here. You are facing a downward sloping demand curve. Differentiated products, you can charge a higher price if you're a Mercedes, you can charge a lower price and sell more if you're a different type of an automobile provider. The MR is obviously more steeper than your demand curve, and this is something we've discussed earlier, why that happens, right? Think of a toothpaste market. If some people believe Sensodyne is better, so then they might be willing to pay a higher price for it. Or however, if some people don't want to do that, then naturally the price will go down. Therefore, price and quantity are inversely related. The short-term profit is maximized at MC is equal to MR. Sorry, this point over here. And if you just take that up to the demand curve, you'll get your price. And if you take that up to the average cost curve, you'll take your cost. The quantity is here. This is your cost box, this is your revenue box, and this is your profit box. So in terms of your economic profit, this is your profit revenue, which is price into quantity, minus your cost, which is cost per unit into quantity, and what you get is this profit box over here. So profit is going to be maximized at MC is equal to MR. That is the level of quantity you will produce, and the price is determined on the downward sloping demand curve. Now, how is this different from perfect competition? In perfect competition, we had this flat price, which was also the marginal revenue, and firms are price takers, and then at whichever point the MC is going to cut this, that is where we're going to produce in a perfect competition. So the firm produced, and it was dependent on its cost curve, because obviously the price is something which is not changing in the case of your perfect competition. But in monopolistic competition, we see that the price also changes because the demand curve is downward sloping. And however, for a perfect competition, it is only dependent on the cost. In the short run, in the perfect competition, we saw that the firm's supply curve was the MC curve, which basically means that the firm is willing to supply according to its marginal cost. The higher the cost, the higher the price it will charge for that quantity. The lower the cost, the lower the price it will charge for that quantity, right? And the MR curve was a flat line which was equal to its price. Now, in monopolistic competition, the price is not fixed. There is no single price. It depends on how you want to position yourself. That is determined by this downward sloping demand curve. Higher prices, lower volume, lower prices, higher volume. And the supply curve, which is not shown, is your MC over here, which the firm supply curve must show the quantity the firm is willing to supply, which is not shown by the MC curve over here. So what the point is being emphasized over here is that unlike your perfect competition, where your supply curve is, because of it's driven by the marginal cost curve, that is where the firm is willing to supply. Here it's going to be different. Here obviously it will be based on your profitability, because what they will want to do in terms of the supply or the output is that they will want to supply at a level where MC is equal to MR. And if you take this MC down to where your MR is being intersecting, that is the point where the profit will be maximized. And again, coming back to that same discussion of the cost box and the profit box. Right, so your total profit is going to be your total revenue minus your total cost. Now the prices are usually higher and the quantity is lower relative to perfect competition. So in perfect competition, the price will be fixed because of the amount of competition. In monopolistic competition, we're going to usually charge a higher price, and therefore the quantity that we will supply will be low. And that is how we're going to increase the price, by restricting the supply and by increasing the price that people will be willing to pay for the lower supply, right? And that you can see over here, that if we're talking about perfect competition, you know that perfect competition always comes to that point of price where the cost curve, the average cost curve, is the lowest, right? So this is where perfect competition comes to. And remember please that cost includes cost of capital here. We're talking about economic costs. So even though in perfect competition the price comes to the point of break even where average total cost is just covered, that doesn't mean that they're in a loss or they are in zero profits. They are in positive accounting profits. It's just that they are in zero economic profits. And that's where your perfect competition quantity and price will be. So the price for perfect competition and your quantity for perfect competition will be at this point, which is the lowest point of the average total cost curve. And that is why it's best for the society, because they get a price which is the best in terms of the lowest cost point for the producers. But in monopolistic competition, of course, we are going to try and milk out a little bit extra profit by reducing the quantity, increasing the price, and therefore maximizing our profit, where MC is equals to MR, right? So by producing at this point little bit lesser volume, little bit higher price, and creating some economic profit for ourselves. Now, what happens with this situation is that think of it like Samsung and Huawei charging a higher price, selling lower volume, and then comes in Redmi and Xiaomi, and they've got these new products coming in at lower prices. So what they do is they push this demand curve down, they push this MR curve down, and thereby what happens is that the MC is equals to MR is basically going to be adjusted. So the previous MR was here and the previous MC was here, right? That quantity was still less than the perfect competition, but it will be even lesser now. But look at the price. The price previously was going to be here based on the old demand curve, but now the demand curve has moved to this new one, and here the new price will be a little bit lower. So even though the quantity has come down, the price has actually come down as well. And why does this happen? Because the original demand and marginal revenue curves have shifted downwards, shown by these dashed lines, when new firms enter the market. And think of Redmi and Xiaomi, that they will come in, and even if it is not perfect competition, it is like your monopolistic competition, that a lot of firms can be there, barriers to entry are relatively low, and they come in and they produce these products and they reduce the price at which everybody is selling. And why do they do that? Because of the economic profits. In perfect competition, there is zero economic profit, right? But in monopolistic competition, there is some economic profit in the short run, but which encourages new firms to enter, since the barriers to entry are low, and then the economic profit goes away as the number of products in the market increases. And therefore, in the long run, what will happen is that firms will enter, your price will come to that average total cost bottom point, and therefore, well, not exactly at the average total cost bottom point, still a little bit above that. So as you can see, and this is again an important point from your exam perspective, that even after the economic profit is gone, your quantity of marginal of monopolistic competition is not exactly the same as your perfect competition. It is still less than your perfect competition, and the price is still a little bit more, right? But nevertheless, economic profit will be zero at this point, because it is intersecting your average total cost curve. So it is at a break even, not at the lowest point. From a society perspective, perfect competition is still better, because it encourages more quantity until you produce at the point where average total cost could be lowest at a price which is even lesser. But that doesn't happen in monopolistic competition. But nevertheless, economic profit will be gone. And your quantity for monopolistic competition and price for monopolistic competition will be the equilibrium quantity and price. And at this point, you can see that the price is higher and the quantity is lower compared to perfect competition. And this is an exam point, that monopolistic competition equilibrium price, the quantity is lower and the price is higher compared to perfect competition. Now, this table summarizes the differences and similarities between perfect competition and monopolistic competition. Obviously, the similarity is that in both scenarios, your long-run economic profit is zero, and the profit maximizing point is MC is equal to MR. Now, the differences is a little bit more complicated. So in the long run, the profit maximizing output of MC is lower than perfect competition. So we already saw that, right? The economic cost in MC is including advertising costs. So we know that there is no advertising in perfect competition, but there is advertising in monopolistic competition, and therefore that cost will be there and it is included in the total cost. Now, what is this surplus? So let's say this is the supply and this is the demand, right? And for perfect competition, of course, the supply is shown by your MC curve. But just to keep it simple, I'm just going to draw this part of the MC curve, the upward sloping part, and call it supply. And what I want to talk about is this little triangle over here, which is called your consumer surplus, which basically means that even though this is the price at which you're going to be selling your products, there are people on this demand curve that who would have paid a higher price. So there is a certain consumer surplus which is maximized in the case of your perfect competition, but it is not maximized in the case of monopolistic competition, because here the price we charge is a little bit higher. The price in the case of monopolistic competition is higher than the price in the case of the perfect competition. So some of that surplus is actually called deadweight loss, because these firms have some amount of pricing power, and by advertising and differentiating their products, they're taking some of that higher price and taking that surplus into dead weight loss, right? So in monopolistic competition, the price is greater than your marginal cost, but in your perfect competition, the price is the same as the marginal cost, and prices are lower in perfect competition. And consumers, even though the prices are lower, so that's good for consumers, but it's not good for their variety. In monopolistic competition, the prices are a little bit higher, but you get different products, and that's got to count for something, right?